So we've surveyed over 1,000 seven-figure Australian business owners, and the scary statistic is that over 76% have all of their eggs in one or two wealth baskets, meaning that they are exposed to market downturns and potentially they could be deferring their path to creating financial freedom due to a simple lack of diversification. We've worked through the responses to our financial performance scorecard that we've had over the last few years, and we've gone deep on trying to unpack the insights that help you apply what we've learned so you can start supercharging and fast tracking your path to creating financial freedom for yourself. Now, if you haven't completed the financial performance scorecard, click the link below. It'll take you 5 minutes to complete it and you'll get a customized report, which will hopefully help you contextualize what I'm going to be covering in this video. Now, the interesting statistic was that 76% of the people that we surveyed that had a seven-figure business have all of their wealth in one or two baskets, right? An industry downturn or a property market correction could potentially wipe them out and could set them back years, if not decades. So let's talk about how we approach this. Now, we have a philosophy that we call the investment operating system that we implement for all of our clients. So if you guys have followed me for a while, you know that we have a proven process for building wealth. There are only 3 ways to build wealth predictably in this world. There is business, there is property, and there is shares. First and foremost, let's talk about your business equity, okay? For most business owners, this is going to represent about 40 to 60% of your overall portfolio. And then, of course, we want to try and dilute this over time so you can diversify away from the business. So what we've got to realize is that your business is your best wealth creation vehicle during the accumulation phase. You can actively be involved. You can improve the profits. As a result, you can increase your personal income and increase your surplus, which then allows you to go and build more wealth. In addition to that, we want to build equity into the business so one day you can sell it. And it's very, very important that we do this because for many business owners, you have a tremendous opportunity. In Australia, you can sell your business for up to $6 million. And if you meet certain conditions under the small business CGT concessions, you can sell that business tax-free. In many cases, worst case, it's a 75% reduction on the tax that you would pay. Incredible. One of the most lucrative rules that exist. But so many business owners sleep on this because they don't have the right strategy. Now, it's important to understand that your business is an active investment asset. It's risky and you need to be actively involved. So our goal is maximize profit and then systematically work toward building intrinsic value so we can sell that business one day. It usually takes us 1 to 3 years to prepare a business for sale. Now, be mindful, your business is illiquid. It can potentially have great returns, but we're not guaranteed. So our goal is to actually create financial freedom without you having to sell your business. Now, pillar number 2 is property investment. And the idea is that this should be between 20 and 40% of your overall wealth creation. And business owners love property. Like this is the next area that I think business owners have built a tremendous amount of wealth. And the reason for it is because property allows us to go and borrow money from the bank and increase our cash on cash returns, magnifying our compounding. So to put it into perspective, let's say you've got 100 grand, you use it as a deposit, you go borrow 900 grand and you buy $1 million property. But that property goes up by 5%. That is now going to be a $50,000 improvement on that property value, but it's a 50% cash on cash return because you've only put in 100 grand. So that's a significant improvement. So we can compound our wealth very, very quickly. So the goal for property, let's talk about residential property first, is we want to increase our asset base as quickly as we possibly can. So our goal is to buy as many good quality blue chip properties as we possibly can that allow us to compound our wealth. So for many of our clients, our goal is to get to 5 good quality blue chip properties. And that might be 1 property every 1 to 2 years. And then essentially we allow that to run its course. Now, residential real estate is horrible for passive income, right? You might be getting a 4% yield right now. So in other words, if you've got a $1 million property, you might make 40 grand, but that's a gross return. You've got to pay strata or council rates. You've got to pay insurance. You've got to pay a real estate manager. You've got to have other upkeep and maintenance expenses. So you got the mortgage as well. Best case scenario, even if the mortgage was paid off, you're going to make a 2 or 3% return, which is pretty crap return on equity. So the idea of property is to build the asset base. And at some point in time, as you work towards your drawdown phase or your income requirement phase, we need to transition that wealth into income producing asset, which we'll talk about separately. So the other big goal of residential real estate is that we have the ability to leverage tax benefits on that. We've got depreciation benefits that we can have. We've got negative gearing benefits. This is the goal. We want to make sure that we can, of course, minimize the holding costs of that portfolio, wherever possible, maximize the tax advantages, and then compound the wealth. And the next part is commercial real estate. So once we've got clients who have built a good residential base, usually that's going to be about $5 million in investment assets, we then start considering commercial. And commercial is usually for income. It does have higher risk because we're betting on other people's small businesses who are our tenants. There's typically longer vacancy depending on where you're buying. You're usually also buying at a higher price. So good commercial usually exists at $2 million plus. And the benefit of that, though, is we're getting higher income. You might get 6 or 8% yield on that asset. Better yet, the tenant pays for all of the outgoings. So that is a great advantage. Now, pillar number 3 is our liquid investment. So this is kind of 10 to 30% of our allocation, but obviously this shifts depending on the life stage. And the idea is getting into the share market. The benefit of the share market is broad diversification and liquidity. We can invest in a particular company with as little as $1,000, in some cases even less. You can go and buy an index fund that gives you exposure to 300 or 500 companies for as little as $1,000, potentially even less. So the benefit here is that we want to make sure that we can get fractional exposure to great businesses globally that have a long track history and allow us to be able to create liquidity. Because the great thing about the share market that we don't get in business and property is that we can sell each share if we want. We can create liquidity very, very quickly. And we can also drip feed our money into the market as opposed to our business. We're all in or we're all out. And same thing with property. You can't sell a kitchen sink if you never raise money. So our goal here is to diversify into the share market. But this is not about stock picking, guys. This is about utilizing diversified ways of investing in whole markets. I use index investing, where I can go and buy an index fund that has 100, a couple hundred, even a couple of thousand underlying investments, and allows us to get the average of however the market performed over time. Makes it very, very easy. It's very, very low cost, and it provides ability for us to get broad diversification. So what we're going to consider is that there are life stages of investing. For most of you, and most of the clients that we work with, you're between the ages of 35 and 45. And this is our aggressive accumulation phase. So usually what we see is that most people have like 60 to 80% of their wealth in their business. They've got kind of 30 to 40% of their wealth in property, and then whatever's left is in liquid, which is usually cash or a very little amount in super and shares. The goal is build the business, build that business. We're now at 7 figures. We want to get to 7 figures profit. We can maximize the surplus. And then we use that surplus to accelerate our wealth building, buy as much good quality real estate and start diversifying into the share market. We have a higher risk profile because we've got more time to wait. So this is where we build our asset base, and that is our goal. Then we get to ages 45 to 55. This is the optimization phase. So we usually see that you might have 50% of your wealth in the business, 35% in property, 15% in liquid. So our goal is we want a balance of growth with risk management. We want to start consciously considering how we shift from capital growth to passive income, disposing of some assets that are high growth and low income, transitioning into moderate growth and high income. So they might be residential to commercial. They might be going from high growth, blue chip US stocks into dividend paying stocks. Not all of the portfolio, but we want to start gradually starting to make those shifts. And we also want to start considering how do we continue to build super, because super is the only way that we can get to 60 plus. And if we structure that in pension, we pay 0 tax on earnings and we pay 0 tax on any distributions that we pay out. So that's a phenomenal outcome if we can structure that appropriately, that we can't touch it until we're 60. And then 55 plus, we want to get to preservation phase. So ideally, we want to dilute the business to less than 30%. Property is kind of 30%. And then we want to have liquid of 30%, right? So we want to focus on that income generation. We want to focus on wealth preservation. And of course, at that stage of the game, we want to be focusing on the exit plan for the business. And how do we create the liquidity we need to be financially free? We need liquid, passive income. You don't have to rely on selling assets and be exposed to the market volatility. It's incredibly important. So the idea here, guys, is that as a 7-figure business owner, you need to start shifting your bandwidth to building wealth and optimizing your wealth to creating financial freedom. The reason why you've got all your eggs in one basket is because that's what you've always known. It's what you've lived and breathed. And it's not unless you've got an investment operating system, a framework to optimize your wealth, are you going to start being smart with your trajectory to creating financial freedom. And where do you start? the Financial Performance Scorecard. Take 5 minutes, click the link below, complete the Financial Performance Scorecard. It'll give you a customized report across your profit, across your tax, and across your wealth strategy. And that'll help you evaluate exactly where you need to focus your attention, so then you can work out exactly where you need to focus that attention and make sure that you can optimize and improve. Complete the scorecard, get the customized report, and let's work out exactly what you can do to diversify your wealth strategy.